Welcome back. You're still tuned into Trading Hour. Well, DEE Development posted a good set of earnings with its profits and margins expanding YOY, while Orderbook too growing 48% sequentially. Mr. Sameer Agarwal, the CFO at the company, is joining us now to discuss the quarter gone by and the outlook going forward. Mr. Agarwal, good morning. Thank you so much for joining in. Well, it's been a good quarter when we talk about the order book improvement. But I wanted to talk about the gross margins because it has seen a substantial decline this time around. The cost of goods sold has gone higher. The power segment's EBIT has fallen 674 basis points on a YOY basis. Can you explain what happened here? Are the raw material prices higher right now? And what is the outlook in terms of gross and EBITDA margins going forward?
So very good morning. Thank you. So as far as the order book is concerned, rightly, we have grabbed a new order from Dow Chemical, which is of 340 odd crore rupees. So it has increased our order book from 800 crores to 1192 crores as at 30th September 2024. As far as gross margins and EBITDA margins are concerned, if you see, there is a growth from last year to this year of 192 basis point from September 2023 to 2024. Vis-a-vis gross margins are concerned, so we are basically working on projects, and it depends upon the nature of the status of the project at which we are executing our jobs. So gross margins, if you see on quarter, there may be a change, but broadly, if we see on year basis, that always remain constant, and that has been remained constant over a last 10 to 15 years. So it has been the tendency of the business. This has been remained constant over the period.
Right. So you expect it to remain constant for the whole year. So we could expect this 70% range around for gross margin, 65 to 70. And also in terms of EBITDA margins for FY25, what is it that we're watching out for? Last year it was 13% around the EBITDA margin. This time it's around 15% for Q2 I'm talking. Do you think for the full year this 15% range is sustainable in EBITDA margins?
As we have already told that we are ramping our new facility, which is at Anjar near Kutch, that will be rolled out with effect from 1st January. And we are transferring our oil and gas sector business from our present pioneer unit at Palwal to that facility, which shall bring down our lot of logistics cost as well as some operational efficiencies. And at the same time, since the capacities have been increased, therefore there would be huge amount of saving in terms of allocation of fixed costs. So all these 3-4 factors will definitely increase our EBITDA margins from 15% to anywhere around 20% or more. And as far as gross margins are concerned, they will also improve a little bit, but they will remain constant. So there would be a good amount of increase in EBITDA margins going forward.
About this 20% mark?
Yes.
By when would that happen?
So, ma'am, currently we are at transition phase. We have got delay of 6 months due to disruptions of rains to ramp up our Anjar facility. And from the next quarter, we shall be getting better and better. And once we will start getting the orders from power sector, that will give us a good amount of boost to enhance our EBITDA.
Okay. You know, this is about margins, and you think that will be around 20% levels in next 18 to 24 months. Is that a fair assumption?
Yes.
Okay. So your cash conversion cycle, it has, I would say it has seen or stretched a bit, 213 days in Q2 versus around 162 days that you saw in the previous quarter and 172 days that you saw in Q1. What has led to that, and where do you stand in terms of working capital cycle?
So as you know, ma'am, it is an inherent nature of our business since we are dealing in projects and we have a hedging philosophy of procuring the material the moment we get the orders. And since the order book has increased, therefore we have to procure the material at that point of time, and that is why our working capital cycle has gone a bit increased by number of days, and it will come down to the normal level the moment we will start our executing the jobs.
Okay, sure. Just a last word in terms of growth, right? I want to understand in terms of the mix. You had previously guided that exports and the domestic front would be a 50-50 mix that we would be seeing from the company. So far this year, exports was something that was driving the growth. So going forward, how are we seeing export growth, and what is the mix that you're watching out for, and a growth guidance for FY25 that you're looking at 8 to 10%?
So, as far as the overall business principles and philosophy, we are having a good balance in terms of our domestic as well as export market. Currently, I can say that we have more export orders, but going forward, since we are expecting good amount of orders from power sector, and those all will flow from domestic sectors. So by and large, we shall be hang around 50-50% domestic as well as export market. As far as the gross margins are concerned or EBITDA margins are concerned, our business philosophy remains same. Therefore, there will not be any kind of impact going forward if there is any way increase or decrease in export or domestic ratios.
Okay. All right, take that point, Mr. Agarwal. Thank you so much for joining in with all those details. So that's the word coming in from DEE Development Engineers. Strong order book. The stock, though, is lower by 2.5%, but they expect improvement in margins going forward as well. We'll slip into a short break. We'll tell you why Honasa Consumer is under pressure on the other side and talk about other stocks in focus as well. Stay tuned.